Jennifer, it's Bob. I'm on, but I'm got my video set. Although I can see and hear you, I'm thinking.
All right, so we are up to about 70 people. I'll keep letting everyone in. Good afternoon, good evening to all of you. I'm Jennifer Julier from the Yale Alumni Association. I want to welcome you to this great meeting, class of 65. And I wanted to just give you a little bit of housekeeping before we get started. If possible, please rename yourself so that we know who you are. Also, kindly remain on mute throughout David's talk. We don't want any unwanted background sound, as you can imagine. If you would like to submit questions to David, you can do so at any time via the chat function. And he will answer your questions, or some of them, at the end of his talk. Chris Cook and Dan Dennison are going to be our two chat monitors. They're going to be the ones who are curating the questions and feeding them to David. This session is being recorded and it will be posted on the class website, yale1965.org, after it's been fixed up a little bit. So if you know anybody that missed the meeting, just let them know that they can go to the website. After David does his Q&A, feel free to stay with us for some socializing. Depending on how many stay, we may create some breakout rooms for little 10-minute chats, and then maybe we'll shuffle everybody again. If you were here the last time around, when we had the class dinner, we had some difficulty with the breakout rooms. Part of that was the Zoom itself being very slow. That may happen again today. So if I say we're going to the breakout rooms and you're sitting there twiddling your thumbs, it's because sometimes it just takes a little bit longer. That's it from me.
One thing, when you submit to chat, make sure you put chat to everyone, because that's the part of the chat room that Dennis and Dan will be monitoring. So now over to Bob Hammond.
How you doing? Our first virtual event was on May 20th. We had the presentation of a fascinating joint reunion survey with a class of 70, and it was enthusiastically received. On October 30th, over 120 classmates and widows pre-registered to hear our engaging class dinner speaker, James Hatch. And if you missed either of those talks, you can watch them on the class website, yale1965.org. The Y, by the way, is lowercase in that address. So far this afternoon, over 180, no, I take it back. So far, between all of these events, 180 different classmates have registered for at least one event. Building on this momentum, this afternoon's speaker inaugurates a new monthly series of Zoom class get-togethers that we hope will attract a wider participation, even wider, in our class community. Please mark your calendars for Wednesday of the third week of each month at 4 p.m. Eastern Standard Time, and watch your email for announcements. We welcome your feedback. If any of you would like to volunteer to be a speaker in this series, or you have a suggestion of a speaker that we should contact, or you have some constructive comments, please get in touch with us and let us know. I'll post my email in the chat room. Thank you.
Okay, as Bob just mentioned, the ideas for these gatherings will come from you, the classmates. And this gathering was suggested by Stan Trotman and several others who have had a lot of respect for our speaker of today. But it also required the participation of another classmate, Bruce Alexander, who has been a longtime colleague of our speaker. And we thank Bruce for making this possible. But besides thanking him, it's really time for us to take an opportunity to congratulate Bruce, because last week he received Yale's highest award for service to the university, the Yale Medal. So I think we should applaud Bruce for that. And actually, we don't have it here. I was going to show the clap function on below, but I don't see it. So today we launch
Thank you.
our.
Thank you. It's very kind of you.
Today we launch our monthly series of virtual class gatherings with a talk by the Chief Investment Officer of Yale, David Swensen. David Swensen went to the University of Wisconsin in River Falls, excuse me. He studied economics with James Tobin at Yale and got his PhD, and then left academia, it seemed, to go off to Wall Street, where he started writing some of the first structured early swap agreements. When Yale started searching for a new manager of its endowment, he seemed like a natural choice to some of the people in the economics department. And they turned to David. At the age of 31 years old, he came to take over Yale, and he took a big pay cut to do it. So we thank David for all of his sacrifices. When David came to the helm of the endowment, it had about $1 billion in assets, largely invested in the traditional way of stocks, fixed income, and cash. Today's endowment is more than $31 billion and has actually very few individual stock issues. And instead, he has a lot of alternative assets in hedge funds, private equity, real property, minerals, things of that nature. David's team does not manage the assets. They allocate the assets among investment managers. So he has a team of outside managers, but he has an in-house team that he's trained, and those people that he has trained have gone off to other institutions and are investing the money of the endowments of those institutions in a way similar to David. And that's called the endowment model of investment these days, because it has a longer time horizon. So it's able to take more illiquid assets. Over the past 30 years, Yale's investments have returned 12.4% per annum. And if you're interested in more detail, I urge you to go to the endowment's website, where there are annual reports and press releases, which are really quite extensive. And it's sort of Yale's Berkshire Hathaway report, you might say. They're quite good to look at, quite informative. Before David's return to Yale, Yale had already taken steps to be one of the first institutions to formally address ethical responsibilities of institutional investors. In 2016, we made a formal change in terms of climate change, and that officially became part of Yale's investment strategy and consideration. In October, David took another step to do good. In a letter sent to the endowment managers, he announced that the investment managers would be evaluated in part on their efforts to recruit and train people from diverse social backgrounds. It seemed that this is a way to break up the clubby investment community to a more diverse group of perspectives. On December 7th, approximately almost 50 private equity firms and investors launched an initiative to increase diversity in the industry. One question I would have, although David would be too modest to answer it, is whether he had an impact upon that direction of the powers that be. So with that said, I now pass it on to David.
Well, Dennis, thank you so much for that very nice introduction. I was going to give a shout out to my friend Bruce Alexander, but that's already been done. But one of the things that you mentioned in your kind introduction was that a number of people that used to work for me are managing endowments elsewhere. And in fact, there are 14 people that used to work with me who have headed up endowment or foundation asset management organizations. And one of those 14 is Seth Alexander, Bruce Alexander's son. So I'm going to give Bruce that shout out instead of the Yale Medal shout out. By the way, of those 14 people who took those leadership positions, 9 are women in an industry that doesn't have a lot of women. What I thought I'd do today is talk a little bit about managing the endowment in an era of COVID, bring you up to date on where we are in terms of results, talk a little bit about ethical issues and social responsibility in managing a portfolio of assets, and then open it up for the toughest questions that y'all can come up with. I mean, March doesn't sound like it was that long ago, but it certainly feels like it's been forever. We're on an annual cycle in terms of looking at portfolio allocations for the endowment. And it's in March and April that we put together our recommendations for the June investment committee meeting as to how we want to structure the portfolio. Normally, we rely quite heavily on statistical techniques, analytical work that assumes that the securities returns are normally distributed. And when markets behave normally, that's a pretty good assumption. But in March and April and May, we were in the midst of the beginning of the pandemic, and securities returns were not behaving normally. So it would have been, I think, foolish for us to continue to assume normal market conditions when doing the analysis for how it was that we would recommend the endowment be allocated. For those of you who are familiar with the world of statistics, the correct description for market returns would be that they're distributions with fat tails. Now, what's a fat tail? A fat tail means that the extreme events on the far right hand of the distribution or the far left hand of the distribution occur more frequently than you would have expected if they were normally distributed. And it's quite clear that COVID had created a fat tail, and the alternative to using this standard assumption of normality in the distribution of returns is something that we refer to as scenario analysis. And scenario analysis is something that we do on a fairly routine basis, stress testing the endowment against scenarios that are usually quite horrendous, and seeing whether or not the portfolio can stand up to those stresses. We don't bother having happy fat tails because nobody has any problem spending more money than they expected to have. But there's a big problem in not having enough money to support the institution. So we're always focused on the bad scenarios, the left-hand side of the distribution. Except in this case, we didn't have to make up a scenario. The scenario was given to us by the pandemic. And we decided that we would use Yale's resources to help us understand how the endowment might be affected by the pandemic. On the public health side, we spent time with Akiko Iwasaki, who's a professor of immunobiology. She's been in the New York Times, the Wall Street Journal, NPR, NBC. She's amazing. We spent time with Sten Vermund, who was equally prolific in his public comments on the pandemic. Sten is the Dean of the School of Public Health. And with Akiko's and Sten's assistance, we came up with a base case, negative case, positive case scenario for the pandemic. Of course, we want to know the economic implications of the pandemic so we can then in turn make some assessment about markets. And we had an embarrassment of riches in terms of economists, Steve Barry, Rick Levin, Bill Nordhaus, Nobel Prize winner. And the work that we did caused us to come to the conclusion that we should buttress Yale's financial resources so that we would never be put in a position, or that it would be very unlikely that we'd be put in a position where we would have to sell assets at distressed prices in order to fund our obligations. And there are two fundamental sources of obligations. One is to provide spending to the for the university's expenses. The amount that we're sending to the operating budget this year is $1.5 billion. And you know, if markets took a tumble, I don't think the provost would be very, very happy if I called up and said, hey, can we skip a month? So that's one of those things that you have to do, come hell or high water. But we also have obligations to our venture capital managers and our leverage buyout managers and our real estate managers. And if they call capital from us to fund acquisitions that they're making, that's an obligation that the university has to satisfy. And so as a result of this work, we went out and borrowed $1 billion. And it was quite extraordinary. The offerings were incredibly well received. The rate that we were paying for 10-year money is 1.48%. The rate that we're paying for 5-year money is 0.87%. And so we were able to buy insurance against this concern we had that we might have to liquidate assets at distressed prices. We bought this insurance for what I would say was a very, very inexpensive price. And it actually had two purposes. One is to protect the endowment from ill-timed sales of assets, but the other is to provide funds that we could use to play offense if there were a market disruption. It turns out that our concerns, at least to date, have not come to fruition. At June 30th, 2020, the endowment closed at an all-time high of $31.2 billion. During the fiscal year ended June 30th, 2020, we spent $1.4 billion to support Yale's operations. The university's budget for that year was $4.3 billion. So the endowment ended up providing 35% of Yale's revenues. Now, that's something that many people who are familiar with Yale's financial statements know, but what many people don't realize is that if you look at Yale College, the endowment supplies more than 60% of the budget. And the reason being that the medical school, which is about 45% of the budget, has relatively little endowment. It's clinical revenues, it's research grants, it's contracts, but just a small amount of endowment. So when you think about the rest of the university, the professional schools other than the medical school and Yale College, the degree of support the endowment provides is in the neighborhood of 60%. So this is quite a change from when I first arrived at Yale. I arrived at Yale on April 1st, 1985. As Dennis mentioned, the endowment was $1 billion when I showed up. The amount that we spent to support university operations was $45 million, in contrast to the upcoming year's $1.5 billion. And the degree of support was the lowest that it had been in decades. It was 10% of Yale's budget. So the endowment was much smaller and much less impactful. Over the past 30 years, the endowment has returned 12.6% per annum. If you compare that to a standard issue, typical 60-40 portfolio, 60% stocks, 40% bonds, the amount of value added from Yale's excess returns amounts to $36.6 billion. So that is something that manifests itself in higher spending levels and in higher endowment values. And if you compared Yale's return to the average college over the 30-year period, the amount of value added is $34.2 billion. If you fast forward to today, December 2020, the endowment is at a further all-time high. Within the past week, we passed $34 billion. You'll recall that the June 30th number was 31.2. So the endowment's been growing like a weed. And it's in no small part due to our exposure to the venture capital world. Yale's had the good fortune to have significant exposure to securities like Zoom, Snowflake, Airbnb, and I won't tell you which numbers match up with which of those companies, but in one instance, we had a $5 million cost basis for what's now worth $525 million. In another instance, it's an $11 million cost basis for what's now worth $732 million. And in the third instance, an $11 million cost basis for a position that's worth $360 million. Now, do I think that this is real? Well, it's real in an accounting sense. I know that if you add up the number of shares and multiply times the price that you see on the, I guess it's not a ticker tape anymore, is it? It's all electronic, but I do like the idea of a ticker tape. So if you compare the price on the ticker tape and multiply it by the number of shares, yes, you get those numbers. But I do think that we're in the midst of one of the most speculative markets that I've ever seen. And so I think that these valuations are really quite vulnerable. The only thing I can think of during my career that comes close is the internet bubble in the 1990s. The other day I looked up what Alan Greenspan, when Alan Greenspan said that the stock market was subject to irrational exuberance. That was in 1996, December 96. And I remember at the time thinking, yes, he's absolutely right. The market is hugely speculative. But of course, how long did that bubble last? It lasted until March of 2000. And obviously history doesn't repeat itself, but it rhymes. And I'm not sure exactly how it's going to play out this time. But I think the way that this will end is not dissimilar to the way that the internet bubble ended in the 1990s. So I'm enjoying the fact that the endowment is benefiting from these gains, and I'm doing everything that I can to protect those gains so that there'll be long-term additions to the value of the endowment instead of just a mark-to-market phenomenon that first of all showed a high price and then later showed a low price. But the success that we have in managing through this and benefiting from the speculative nature of the markets will be something that we could talk about 12 or 18 or 24 months from now. So let me move to the final area that I wanted to talk about, and that's ethical investment policies. You know, Yale was the first institution, this is according to the New York Times, the first institution to consider factors other than maximum return in managing endowment assets. We set up in the 1970s an advisory committee on investor responsibility that consists of students, faculty, alums, and staff. That committee advises the Yale Corporation on major issues. Over the years, the committee has considered policies on South Africa, tobacco, genocide in Sudan, assault weapons, among others. And that's a formal process that has worked very, very well And I think something that should make us as people who care about Yale very proud, because there are many institutions that have no formal policy, many institutions that react on an ad hoc basis when an issue comes up that they can't ignore. And for decades, Yale's been in a position where we have a formal mechanism where members of the Yale community can bring issues to the attention of the advisory committee and the corporation and help the institution fashion a reasonable response. But there's more to it than the formal policy that governs how ethical issues are considered by the corporation. I think equally important is how the investments office goes about its day-to-day activities and how the investments office chooses external managers to make individual security decisions. And I would say that using broad strokes, I believe that there is good capitalism and I believe there's bad capitalism. Now, if I didn't believe that most capitalism was good, I wouldn't be any good at my job. I shouldn't be doing this. I should be doing something else. So I'm a capitalist, and I do believe that by and large, the capitalist system results in good outcomes. But that doesn't happen in every instance with every company. And what are some examples of bad capitalism? I think subprime mortgages, subprime auto loans, vaping, payday lending, private prisons. I think there are breakdowns in each of those industries that cause externalities, negative externalities in the areas in which these businesses operate. So when we're looking to hire managers, one of the things that we do is we figure out whether or not the managers have this attitude of, if it's publicly traded, and I'm a manager of publicly traded securities, then I don't care what they do. As long as they make money, I'm going to put them in my portfolio. That would not be somebody that we would be interested in hiring. Now, they might not have the same, somebody that we hire might not have exactly the same point of view as to what good capitalism is and what bad capitalism is. As a matter of fact, I think if everybody on this phone call tried to separate the good capitalism from the bad capitalism, we'd all have different lists. They're all, we care about different things. But if you don't even recognize the problems exist with the system, then I don't think you're thoughtful enough to be a manager for Yale's endowment. The final point that I wanted to address was the letter that I wrote to our managers about diversity. And I think that might have been the reason why I got this invitation to talk to you in the first place. So I guess there was an extra benefit from having written the letter. It really caused quite a buzz. The Wall Street Journal wrote an article that was extremely highly read. The two young women who authored the article had never seen quite a response that was as robust as they saw with this article on diversity, or on Yale's approach to trying to improve diversity in the ranks of the asset management industry. And the basic idea is that there's no reason why the asset management world couldn't reflect the demographics of the country. That it shouldn't be an industry that's dominated by, overwhelmingly dominated by white men, that there's room for people of color, that there's room for women to succeed, but that we need to make a better effort at improving the pipeline and expanding the opportunity set. I didn't want to focus on the quick fix. The quick fix is suggesting that people go out and hire immediately senior people who are women, senior people who are from underrepresented groups, because that's a zero-sum game. If these people are senior in the asset management industry, you're just trading one firm for another, and you're not expanding the pool. And so the focus of my letter was, when you're hiring people, think about hiring from a diverse source. One of the typical complaints is that the investment banks and the consulting firms, which are oftentimes the source of new hires, are the primary hunting grounds for new talent. You're not looking at a diverse group of candidates. Well, if you're not finding a diverse group of candidates there, why not go directly to Yale College, which is marvelously diverse, and hire from that cohort and take responsibility for training these investment analysts yourself. And if you do that, then you're expanding the population of individuals who can have a career in this absolutely fabulous, endlessly fascinating industry. So I was very pleased that the communication that we had with our outside managers and our encouragement to join with the investments office in attempting to improve the diversity of the asset management industry was so well received, not only by our managers, but I think by much of the public at large. So let me stop there so that we've got plenty of time for questions and answers. And I understand that there are two members of the class who are going to be responsible for telling me which questions I'm supposed to answer.
Okay. David, can you hear me? This is Chris Cook in Anchorage, Alaska.
Hey, Chris.
We have some questions that have come in over our chat room or chat line, and I'm going to pick one of them to relay to you, which is from Lee Lundy, and he wants to know if there's a list of Yale's management firms available to us from some source. And I think I would add on to that the question about how do we determine and how do you determine which firms are acting on the guidance and the goals that you presented in your letter?
So it's early days in terms of the letter. We just sent it out a couple months ago. We asked for data as of June 30th. We told our managers that this is something that we're going to monitor every year, so they should expect to hear from us. And we've had individual conversations with each of the managers and said, look, we're going to work hard to make progress in the Yale Investments Office, and we would like you to work hard to make progress in your firms as well. And so the idea is that this is something that's important to us. We wouldn't have written a letter otherwise, and we're going to pay very close attention to how our managers behave. In terms of list of managers, we view that as proprietary information. Spend a lot of time and energy trying to identify these managers. One of the great sayings in the investment management world is size is the enemy of performance. I'd much rather have them stay small and nimble and focused on making money for Yale than having a situation where any institutional investor could pick up a list of Yale's managers and knock on the door and say, hey, we'd like to give you money too. So even though I like to be a nice guy and I like to share, this is something I don't want to share.
Hi, this is Dan Dennison, and Chris and I are going to sort of alternate on asking questions, and I'm picking up on a question that Dennis Mack asked, but to broaden it a little bit. He asked how you put a value on the endowment's holding entities for which there's no market, or the market seems irrationally exuberant. And I'd like to broaden that a little bit by just how you feel about the interim valuations that your investment managers put on their early term venture investments.
That's a really good question. And I think we've taken a very creative approach to getting comfortable with our managers' valuations starting back in 2000. So that was when the internet bubble burst, right? March of 2000. And then we're looking at our June 30th valuation. And I'm worried that our managers are not going to recognize the reality, and we're going to have valuations that are out of touch with reality, and that the endowment will be overvalued, and it would be just fundamentally wrong from a fiduciary perspective. So one of the things we did is we sent around a message to our managers and said, look, oftentimes you only revalue an asset when there's been an external financing event. Third party comes in and pays a certain price and that validates the carrying value. I think you should change your approach. I think you need to look at your portfolio and say to yourself, what would I pay for this asset today? And then mark accordingly. And the way we tested the quality of the marks was to look at all of the exits from the portfolio, whether it's leverage buyouts, venture capital, real estate, oil and gas, whatever, all the exits from the portfolio during the fiscal year, and compare the value of the exit with where it was carried the previous June 30th. Now, what does that do? That tells you that if there's a systematic overvaluation, you're going to see exits at prices that are below that prior June 30th carrying value. If they're roughly equivalent, then you say, well, that's pretty good. If in the third instance, you're exiting at values that are higher than the previous June 30th, that means that the portfolio is pretty conservatively marked. And so we've done this every year now for more than 20 years. And in each year, the illiquid investments that have exited the portfolio produced a higher realization than that previous June 30th mark. So there's a strong conservative bias in terms of where we're marking our illiquid assets.
That's good to know. I've heard that general approach a little bit before. It may not be relevant on a macro basis, but there's been a flood of imitators, not only from endowment funds, but under-reserved pension plans who are wanting to switch out of equities and into venture capital so that they can justify claiming a higher projected return. And I don't know, maybe that's not enough of that to really significantly impact the market, but wondered what your opinion of that was and how that might affect both the competitive availability of good opportunities for your investment managers if there's a lot of other money flowing in competition, but also on whether that was influencing your investment managers who might be tempted to overvalue to help attract that kind of investor.
You know, Dan, you've identified a huge public policy issue. The public pensions overstate expected returns. They use rates to discount their liabilities that are far too high, thereby understating the liability that they have to satisfy. It's a disgrace. And it's something that's going to be paid for by our children and our grandchildren. And it's not something that we should be proud to put on their plate. So I'm very concerned about the integrity of the accounting for state and local pension plans, for corporate pension plans. I think it's a huge public policy issue. But the competition from those sources of capital isn't really a problem for the higher quality investors. I mean, the best managers want to have really high quality partners. And unfortunately, the state and local pension operations are more political than they are investment oriented. And that doesn't make for a good partner. And so I think that I have to worry about competing with Stanford and MIT and Penn and Princeton, but not so much CalPERS or CalSTRS or Texas teachers.
David, I want to forward to you a question that comes from Chris Merck. And he's asking about Hill House Capital, which Yale provided seed capital for. I wasn't familiar with it. I just did a quick look. It's a private equity firm that concentrates on Asia and Southeast Asia. And he wants to know what your view is of the future in that area, whether you're adding risk, holding or reducing, and also your opinion on, let's say, the next 5 years of exposure to the PRC, the People's Republic of China.
So this is another opportunity for me to give a shout out to Seth Alexander, Bruce's son. Seth was working for me at the time. Lei Zhang, the founder of Hill House Capital, had worked in the investments office, was a student of mine. We helped him get a job in the emerging markets arena. He came to us and said he was ready to go off on his own. Seth was trying to help him find seed capital, and the seed capital was going to come from one of our hedge funds. And one day Seth came up to me in the hallway and he said, you know, this hedge fund that was going to provide seed capital is being difficult. What should I do? And I said to Seth, we'll back him. And so Yale ended up committing 25 or $35 million to this startup operation. And it's, I think, a 15-year relationship. And over the 15 years, Lei Zhang at Hill House Capital has added about $3 billion in returns for the university. Now, not just on that 35 million, there were more contributions that have been made over the years, but it was just extraordinary to see somebody who had all the right tools to know how to manage portfolio assets, do it in an environment that was just full of inefficiencies. The Chinese tend to have momentum as the driving force behind investment decisions, meaning if it has gone up, they expect it to continue to go up. And if it has gone down, they expect it to continue to go down. Nothing to do with valuation, just with is it rising or is it falling? And taking basic, sensible security valuation techniques to bear on the problem has produced extraordinary returns, not just for Yale, but for many other endowments and foundations. I think over the 15 years, whether it's been in the venture side, the buyout side, the marketable security side, Hill House has compounded at rates in the mid-20s. It's just extraordinary in the breadth and the depth of what they do. But the interesting part of the question is, what are the risks associated with exposure to China today? And Yale's been reasonably conservative. Maybe it doesn't sound reasonably conservative to you, but we've limited our exposure to China to 10% of the endowment. Most of our sister institutions are probably 14, 15, 16%. But that's one of those numbers where if things go bad, 10% is way too much. But if things continue the way that they have, 10% is not nearly enough. It's one of those numbers that's never going to be right. But we have been cognizant of the risks and controlled our risk by having that limitation. And that limitation has meant that we've sold enormous amounts of Chinese assets, right? Because of our returns have been in the mid-20s, which is roughly true for the last 15 years. We keep on bumping up against the ceiling and selling and bumping up against the ceiling and selling. I think that the Trump administration really damaged relationships between the United States and China, but I'm not very optimistic that there'll be much change in the Biden administration, because I think partly as a consequence of the rhetoric during the Trump administration, China's become very unpopular in the United States. The other day I was looking at a Pew Research survey, and a clear majority of US citizens have a negative view toward China. And so I don't think that there's any political gain to be made by normalizing relationships. And certainly there are issues that need to be addressed. But I am, for one, disappointed in the deterioration of the relationship, and it's something that we're monitoring very carefully. And it could well be that we'll revisit our ceiling of 10% of assets exposed to China because of these extraneous risk factors.
Thank you.
I don't know whether we have a time limitation that is going to have us all disappear off of Zoom here momentarily, but I'd like to pick up on a question that Bob Hammond wrote, which is our Yale's alumni annuity offerings and all invested in the endowment fund. And so I don't know whether there's match funding on that or whether that's just a liability. And a related question might be, when we make this, a lot of people in this class have made restricted donations to Yale for a specific capital objective, whether those are carved out and put in something with a little less downside risk, or whether they relate for better or for worse the same returns as the general fund.
I'm probably not the best person to answer that question. I mean, I do know that there are some annuity assets that are invested in the endowment, and there are some that aren't. And there are some issues related to accounting. There are some issues related to taxes. There are some issues related to risk tolerances, and that's one of those things that other people pay attention to. I'm just trying to make the endowment grow as much as it possibly can with the degree of prudence that we need to take in managing the assets.
My understanding of what you're saying is to say that this is, you run the fund, and it's up to somebody else in the chain to decide whether or not certain liabilities are matched with that fund or with something else, and that they have the ability to create for something else if that's right.
Yeah. That's correct. I think I'm spending 24/7 trying to manage the endowment. I don't have any more time other than that.
David, what someone, Tim Merrill, I think, had a question about fossil fuel investments and with regard to it being whether the ethical questions involved. And that also, to my way of thinking, that also pertains to investments or not investing in environmentally sensitive places like the Arctic for oil exploration and development. What's your opinion of the movement to divest fossil fuel companies from endowments like Yale's?
So if people are interested, we've got some information on our website about our approach. I think we've taken a very principled approach to the question of fossil fuel investment. And the basic idea is, well, and it's beyond fossil fuel investment. There's another letter that I wrote to our managers, and the diversity letter got picked up by the Wall Street Journal. The fossil fuel letter got picked up by the New York Times. So I'm diversifying. And the basic idea was, look, the issue of climate change is an existential threat. If we don't stop consuming dirty fossil fuels, we'll all die. On the other hand, if we stop consuming all fossil fuels right now, we will all die. And so the solution is to, as rapidly as possible, move from consuming fossil fuels to clean energy. So how do you do that? We ask our managers when they're making an investment in anything to take into account the carbon impact of that investment. So it could be a coal mine. Well, if it's a coal mine and you take into account the carbon impact, the investment's going to fail. So you don't invest in coal, you don't invest in tar sands, you don't invest in heavy oil because the carbon content's too high. With the wind power, the hydro, solar, they pass with flying colors. But natural gas also passes because we still need to produce enough power to transport our agricultural products to marketplaces where we can purchase them to heat our homes until we can make a complete transition. So the assumption that there's a carbon tax or a price on carbon that needs to be incorporated into an underwriting of any security purchase, I think is a very sensible way to approach incorporating this really critically important element into managing Yale's portfolio.
I think we have time for one more question. We got started a little late. We're a little past 5, so we're sensitive to your time, David.
Okay.
I'm happy to stick around.
Well, we have a question posed by Mr. Roscoe, but also by Steve Clark that I guess we're all dying for an answer for, and this is strictly anecdotal, I'm sure, but what do you feel is the worst investment decision you made in your 31 years that you might regret?
The worst investment decision. Oh my goodness.
Clearly no stick out.
Oh, no, there's so many to choose from.
Other than coming to the Yale endowment.
Oh, that was the best decision I ever made in my life. you know, I mean, just look at this group that we've got here from the class of 65. I mean, the Yale community is just full of engaged, wonderful, smart, fascinating people. It's such a privilege to be a member of this, community. You know, I would say probably the single worst decision I made was this is very early on in my career, invest with a hedge fund manager that ended up getting in trouble with the federal government for trying to corner auction of treasury securities. And obviously, if I would have known that he was going to do that, I wouldn't have entrusted Yale's money to him. As a matter of fact, I didn't entrust it to him. Something my predecessor did, but it was my responsibility because he was in the portfolio. And what I should have done is I should have fired him. But I think one of the things that taught me was that high ethical standards are paramount, that it doesn't matter if something is incredibly attractive from a rate of return perspective or from a risk reward perspective. If you're not partners with the best people, you're not partners with people of intelligence and integrity and honesty and, you know, all the Boy Scout characteristics or Girl Scout characteristics that you come up with, then you're failing. You know, it's not going to end well. So I would say that's the biggest mistake was firing that manager afterwards, not before.
Thank you.
David, do you want another question or how are we doing on time?
Boy, do you want to go to 5:15? It's 5:10 now.
That sounds perfect.
Okay.
All right, then this is actually another Roscoe question from way back on the chat line. Does ethical investing create a cost in terms of overall performance, or does it create its own source of value?
You know, I think it creates its own source of value. I mean, one of the things that I mentioned earlier was when Jewel came out and was all the rage, one of our managers was talking about investing in it. And he and I had some knockdown, drag out fights. And ultimately the decision was that he would invest, but Yale would not participate in the investment. And we had the same set of discussions with one of our private equity managers in the United Kingdom. And the end result of those discussions was that they passed on the investment. And when 9 months later, we're talking to the manager that made the Jewel investment, pretty much everything that we complained about had come to, or that we were worried about, had come to fruition in terms of regulation of flavors and in terms of the dangers to the young people who were becoming addicted to these flavored bubblegum vaping devices. And the man who made the investment said, I wish I would have listened to you. I shouldn't have done it. And the group in the UK that didn't make the investment, when I saw them, I thought the guy was going to get down on his knees and start crying. He was so happy that that we talked him out of it. And I think you see things like that happen over and over and over again. You know, there are plenty of opportunities to make money in a way that I can be proud of what it is that we're investing in. And I would hope that most of the Yale community would be. I mean, obviously there are going to be disagreements, and there'll be people that'll look at our portfolio and say, well, I never would have done that. But that's because our portfolio reflects the world in which we live in so many different ways. And we're never going to get unanimity, but I think there are just so many opportunities where you can hold your head high. Why stretch? Why go over the edge? Why even get close to the line? And I think there's a feeling out there by people who aren't close to the asset management industry that a lot of the investment managers out there are playing it close to the edge, that they're, I don't know if you read Black Edge. It's about Steve Cohen's firm and Connecticut SAC Capital. And it talks about how they use inside information to make investment decisions. It's a pretty scary book. I don't like it, but you know, you don't have to go anywhere near that in order to put together a portfolio of high quality investment opportunities. And obviously there are reputational risks and other risks associated with using a black edge or getting in the gray area and finding yourself on the wrong side of the line. So no, I don't think there's a cost, and if anything, there's a benefit. There's just an awful lot of really good things that you can be doing out there that will produce really interesting returns, and you don't need to get even remotely close to dirty.
Dennis, you want to thank Mr. Swensen for us?
Still here?
You're on mute, Dennis.
I know. Okay. This has been an outstanding event. I'm really glad we had this. I hope we can get more suggestions from classmates to come out with other programs like this, and that others will volunteer to be the people asking the questions and introducing and etc. But David Swensen has done a magnificent job to launch this series that we're going to have. So thank you very much, David. And all of you who want to stick around, we can chat. Open up your own bottle if you have to. And if we have a lot of people sticking around, you may find yourself with a random group of classmates in a breakout room. So Jennifer, can you?
Thank you very much, David.
Thank
Yes,
you.
Thank you, David.
Thank you.
It's great.
David, that was awesome.
Yes.
Okay, so we're going to breakout rooms. We're going to have probably about 5 of them. And
Why don't we wait until it's melting a little bit? Looks like we have 50 people.
yeah, we've got, it's going down.
Yeah,
Let's see what we end up with.
if only we could lose weight that easily.
I know.
Hey,
So
there's
true.
Yeah, I think we'll be down to our original 4 or
No,
5.
no breakouts, I think. Yep, we're just, we'll get the diehards here.
Yeah.
Oh, my goodness.
We worked with this number after the class dinner, so we won't need to break out.
No.
It was probably your comment about opening a bottle, Dennis.
Yeah, right.
Maybe they'll come back.
But you have to get in the habit of leaving your glass in your bottle right next to your computer so you're ready to go when you're going to talk to your classmates.
So what did everybody think of that session?
He is fabulous. He's a gold standard.
He expresses it well and he's thought it all through.
And
Hi, Kyle.
Hi, Chris. You know, I've been around on the faculty watching David handle the slings and arrows for decades. And he's very gracious in the way that he talks about the experience he's had. Hasn't always been easy. And I think he stayed the course in a way that's, I think a lot of people are concerned about how corporate the university now feels, looks, and acts. And when David fires off one of his missives about what he believes and what his ethics are, people sit up and take listen because it's not what they expect. And I think he's done Yale a great service, as well as making the place rich beyond imagining. I have to personally say I have a little trouble borrowing $1 billion when you have 37 billion coming in. I know there's a difference between 12% annual return and an interest rate of 0.8%. I get the finance, but I struggle at another level with it. But I think David's insistence on, what you said, gold standard. He didn't start off that way. He got there. And I felt whoever snagged him, thank you, Bruce. I feel really privileged that we had the time with him that we did.
Yeah, I agree. And on that billion, Kyle, he really bought that for insurance. He was worried that if the market continued the way it was going in March and April, and he was forced into a fire sale, he would have to basically sell it, at a price that was not a good price. So he wanted to have the ability to pay for a little bit of insurance just to protect the potential illiquidity hit that he might take.
I understand that, Dave, but I'm,
you can always, if you buy insurance and your house didn't burn down, you say to yourself, why the hell did I pay all that premium to have my house not?
Well, I suspect it's a lot easier to borrow $1 billion when you have 31.
Exactly.
I think
Just a little cushion there.
I think what may not be clear to everybody here is what he did is he borrowed money at 1.5% and just is keeping it in cash. But
right.
This is a liquidity function, and normally if you're running an investment thing that has some distributional requirements coming up, you don't put it all into long-term assets. You keep a lot of it in short-term assets that you can get out. And so he deliberately runs a pretty unbalanced long-term portfolio, and he just deliberately shortened it and said, okay, I'm going to invest in some cash and it's going to cost me 1.5% to do it, but that's going to be a lot less to pay than what I'll have to pay for having to sell long-term assets at a huge discount, because we're in a black swan situation here.
So away from this, how's everybody doing in COVID world?
Here we are.
So far, so good. Those of us who here are presumably the healthy ones.
Kent, is that a picture behind you or is that real life?
Yeah, that's a picture I took a couple of years ago. But that's Diamond Head, and I see it every day. So
pretty cool if you have both Alaska and Hawaii on the phone. That's great.
Yeah. I thought this was one of the most interesting discussions. I really, first of all, he's very well spoken, and there were no ums or as or whatever, the intelligence of the guy is just remarkable. And you asked about COVID, and this is my second Zoom conference today. The first one was discussing COVID. I'm on the board of a nonprofit retirement facility, and so we have had tremendous discussions just recently about the vaccine and so forth, and it was very interesting. We had a discussion that was from the mainland, actually, about the whole retirement facility industry and what's been happening. That was very interesting. In Hawaii, we have, I think we're the best state in terms of the percentage of people who have had it and who have died. So we've no problem here, except that our economy is tanked because of no tourism.
Well, my memory from my time working as a consultant in Hawaii is that that economy is totally dependent on Japanese tourists, and that clearly is not on the horizon real soon.
The nice thing used to be that if the Japanese economy went up, generally speaking, the American economy went down. And so there was this sort of interplay going back and forth between pushing all the tourists in from Japan and pushing all the ones in from the mainland. And but now it's basically stopped for everyone because of our legal strictures and the fact that they put a 2-week quarantine on people coming in who haven't had testing showing they're negative. So that's going to continue for a long time, and people are doing surprisingly well despite that. Honestly. So
to the group, I'd like to say, can you guys hear me?
Yeah.
Hanson, something not related to investments, but I've had the opportunity to play golf with David up at Fisher's Island, not far from New Haven, and he loves golf. He brought some of his associates up with him who are so talented, who he's picked out of his classes and so forth. And also, a little footnote, his son won the club championship at the Yale Golf Course a couple of years ago. So that's just a little footnote that there's more to him than just investing. And I gather that his health is good because I know that he's had some health struggles.
Well, it's interesting you raise that, Mike. The truth is, he had an operation 13 days ago.
Wow.
He's recuperating. And Bob, you can explain what it was. It was something, he woke up when he told us before the meeting started exactly what happened. But you probably saw the backdrop. I think he's lying in bed now.
Wow.
So we gave him an out, and he said, "Oh no, I really want to do this. I really want to do it." So he's a hero.
Well, he's a great guy. He came up, Henry McCants asked him up. Henry's on he was class of 64 and on the investment advisory committee. And he's just a delightful guy, and what a talent. It was great. Thanks for putting this together, guys.
Yeah, well, this is more in Kent's field than mine, but he said he had a pathological fracture. So he presumably had a rod put in his femur or something like that.
Yeah, something like that.
yeah, so he must pathological fracture. Usually that means a tumor that's gotten in it. Though infections can do that too.
Right.
But
well, he's been fighting this cancer for
10
years. 8 years now. So
What brand of cancer does he have? Do you know?
You know, I'm not sure.
I think it's some kind of lymphoma. but I'm not sure.
Yeah. But, you know, our next, the next third Wednesday is January 20th, which happens to be Inauguration Day. So we have a dilemma.
Who do we know from the outgoing administration? They'll be free.
Nobody.
From your lips to God's ears. You know, one of the ideas we're seeing if maybe we could get Woodward to come in and talk about the old and the new, but he's probably pretty busy.
It wouldn't be that day if we had him.
Yeah, if we had him, we might break our rule and do it on a day later or something. But we'll come up with something. There's a lot of ideas around. But if anybody has ideas, just let Dennis and Bob know, because I think this could be really cool to do this every month and get a interesting speaker in on all kinds of different topics.
Some of the other things we're looking at are just having musical performances of classmates for one afternoon. And something to do in between these sessions is to organize college-oriented visits. So right now I'm in the process of organizing a group for Morse College to visit with the dean and the head of Morse College and some of the students and take a tour of the college. So if anyone wants to put together one of those, please contact me and I'll give you some leads on how to do it.
I'm going to say goodbye, guys. It's been fun. I'm a one meal a day guy, but breakfast is coming up. I'm late for breakfast. I better go do it.
Thanks for a great job, Dan. You did terrific.
Thanks for inviting me. Thanks for inviting me.
Thanks. Bye-bye.
Thanks.
Thank you.
So Hanson, where are you?
Where I've been for the last year in Florida. I haven't moved. And nobody's coming for the holidays, but we're doing well, thanks. And hopefully we're close to the end of this. So hope to see everybody. Any news on the reunion? They haven't made any decisions, I don't think. Yeah. No,
Jennifer's going like that. They don't know. You know, we ought to have an award for the first person in the class to get vaccinated.
That'd be interesting.
And we could have a Zoom session on that. We could have them come in and tell us all about it.
It's either a front care health worker or the oldest person with the most comorbidities.
Yeah.
So,
That's sad.
Yeah, what category can you slide in under?
Right.
Anyway, this was great, guys.
Yeah.
Thanks for doing this. It's wonderful.
Yeah, I've got to run myself, but feel free to stick around as long as you want. But I do all the cooking in our house. And my wife just told me she's getting hungry, so I have to go.
Thanks a lot.
It's not even 8 o'clock yet.
David, I've got to ask you, your lighting is impeccable. How do you do this? What kind of,
What?
I mean, this is a real background here and it's fantastic. How have you done it?
This is my office.
You've done nothing. It's just natural.
My office.
Wow.
Right.
Okay. It's fantastic. Great to see everybody.
See ya. Bye.
Bye-bye.
Good to see you.
Okay, bye.
Bye.
Happy
Thank
holidays.
you. Bye.
Yeah.
Same to everybody. Thanks.
Bye-bye.
Come again.
Thanks for coming. Thanks, Jennifer.
You're welcome.
Thank you. Good. Like your background.
Thank you.
We
We're
have to have a
expecting
class
snow
on how to
tonight.
do that.
It's cross campus. You can see it.
Dennis, is it snowing in the city yet?
No, we have snow showers.
No. They're talking about a foot tonight, aren't they?
8 to 10 in the city.
Oh. Okay.
Up north will be a lot.
Take care.
We had our
Good,
first
Bill.
snow in 190 days last week.
What?
We had our first rain in 190 days last
Wow.
week in Scottsdale.
Wow.
Did
This
your
is Arizona, right?
Yep, Scottsdale.
Geez.
Lee, do you ever run into Bob Kinderman?
Haven't.
He lives in Scottsdale.
Well, you got to understand, Scottsdale is probably 30-something miles north to south. I live up where the road sign says Carefree, 1 mile. That means that's the next town.
He lives in Desert Mountain, wherever that is.
Desert Mountain is quite a ways east of us and north slightly.
Yeah. Well, anyway, take care.
You too. Thanks a lot.
We're down to the four of us. I'm gonna leave. Bye-bye.
Bye.
All right.